Robinhood. You hear that name and you immediately think of shaking up Wall Street, right? Of giving power to the everyday investor. But, after a truly wild ride since its IPO, the big question is still hanging out there. Is Robinhood this revolutionary company that's built to last, or is it a risky bet that's already had its 15 minutes of fame? Today, we're going to dig in and evaluate Hood as a long-term investment.
And I mean, just take a look at this chart. It really tells a story, doesn't it? A dramatic story of a massive boom and a pretty painful bust. This isn't just a random stock chart. It's the whole conflict we're exploring today, visualized. We've seen the high, we've seen the low, but what we really want to know is, what's the next chapter look like?
Okay, so to figure that out, we're basically going to look at the two sides of the Robinhood coin. We'll kick things off with what we're calling Robinhood's second act and see how it's building a new kind of financial fortress. Then, of course, we've got to check if the numbers actually support the story. From there, we'll flip over to the other side: valuation, market trends, all the risks. And finally, we'll tie it all together with the investor's dilemma.
All right, let's dive right into the bull case. The whole story here is that Robinhood is in the middle of this pretty profound transformation, a second act, if you will, that goes way, way beyond just being the app for free trades.
And here is the absolutely crucial point you've got to get. The Robinhood of today is not the Robinhood of 2021, not even close. They are aggressively pushing to become a one-stop shop for your entire financial life. So you need to think less like a simple broker and more like a complete financial hub. That simple shift, it changes the entire investment thesis.
In investing, people talk a lot about a moat. It's that sustainable competitive advantage a company has that protects it from all the rivals trying to take a piece of the pie. Well, Robinhood's original moat kind of dried up, so they've been working like crazy to dig a new one, and this one looks a lot deeper.
And the contrast here is just night and day. The old moat, free trades and a really slick app. I mean, that was genius at the time, but let's be honest, it was pretty easily copied by the big guys like Schwab and Fidelity. The new moat is all about stickiness, building an ecosystem that's so interconnected and so valuable that as a user, you'd never even think about leaving. And that is much, much harder for competitors to copy.
So what's holding up this new fortress? Well, it's a whole bunch of things. They're adding social trading so you can see what the community's doing with verified performance. They've partnered with the government to integrate U.S. Treasury accounts, which is a great way to bring in the next generation of investors. Their gold subscription is more powerful than ever. They've even got a fund that gives regular folks access to private companies. And they're finally expanding overseas to the UK, Europe, and Asia to spread out their risk. It's a full-court press to build that stickiness.
Okay, that's a fantastic story, right? But a good story is nothing if the numbers don't back it up. So let's shift gears and look at the financials and see if this big transformation is actually, making them any money. And wow. Yeah, the numbers are talking. In 2025, revenue just soared 52%, hitting almost $4.5 billion. And get this, after losing money back in 2022, they pulled in nearly $1.9 billion in net income. And the return on equity, which is just a fancy way of saying how well they use shareholder money, is over 20%. That is the sign of a highly profitable machine. This is the turnaround right here in a bar chart.
But for me, this is the number that really jumps off the page: $1.6 billion. That is how much free cash flow Robinhood cranked out in 2025. This is pure cash the company can use for whatever it wants: buy back stock, buy other companies, or just plow it back into growth. It is the absolute lifeblood of a healthy company, and Robinhood is generating a ton of it.
Okay, so let's recap the bull case. We have a high-quality, very profitable, cash-gushing company with a really smart strategy. But, and this is a huge, huge but, a great company does not automatically make for a great investment. The price you pay for it matters a lot.
And that leads us right into the core question of the bear case. We know the business is firing on all cylinders, but how do we take all that amazing growth and all that cash and translate it into a fair price for one share of the stock? What's it actually worth?
Well, the main tool we use for that is something called a discounted cash flow analysis, or a DCF. Now, I know it sounds super complicated, but the idea behind it is actually pretty simple. A company's value today is basically just all the cash it's ever going to make in the future, but pulled back to what that cash is worth in today's dollars.
And really, we can break the whole thing down into 4 simple steps. First, you guess what the cash flows will be for the next 5 years or so. Second, you estimate its value for all the years after that.
Third, you discount all that future money back to today's value. And finally, you divide by the number of shares out there. And boom, that gives you a pretty good estimate of its intrinsic value per share. So, after running all the numbers, using some optimistic but what we think are reasonable assumptions, what do we find? The calculated intrinsic value spits out at about $71 a share. Now compare that to the market price of around $70. They are almost identical.
So what does that mean? It means the market seems to be pricing Robinhood just about perfectly. And for an investor, that means there's a very, very thin margin of safety. Think of that as your cushion, your buffer, in case things don't go exactly as planned. Right now, that cushion is pretty much gone. The current price already has a lot of the good news baked right in. Okay, so the fundamental value tells us the stock is fairly priced. But what about the market's mood? What's the sentiment out there? For that, we need to switch from the spreadsheets to the charts and see how the market is actually voting on the stock right now.
We're back to our chart, but this time we're looking at it with a technical analysis lens. This pattern you see here is what analysts call a classic ABC corrective wave. It's part of something called Elliott wave theory, which is really just a way to analyze market psychology by looking for repeating patterns. And this three-wave pattern often shows up after a big run-up, and what it's suggesting is that this current downtrend, what we call wave C, might still have more room to fall.
This table here breaks it down really nicely. Wave A was that first, really sharp drop. Wave B was that little bounce you see in the middle, a classic dead cat bounce, a temporary recovery that ultimately failed. And right now, we are smack in the middle of Wave C, which is a strong decline that technical analysts believe is targeting a support level right around $60.
So based on that analysis, there are pretty much three ways this could play out. The primary most likely scenario is that the stock continues its slide down to test that $60 support level. It's possible it finds a bottom right around where it is now, but there is a real risk here. If that $60 level breaks, we could see a much, much deeper fall. So while anything can happen, the technicals suggest the path of least resistance, for now, is down.
And this brings us right to the core of the issue for anyone thinking about investing. It's a conflict. On one side, you've got this high-quality, rapidly growing business. And on the other, you have a stock that seems to be fully valued and has a bearish short-term trend. What do you do?
And this slide just sums it all up perfectly, doesn't it? On the left, the bull case for the company. A successful turnaround, a durable new moat, tons of cash, and a smart management team. Looks great. But on the right, the bear case for the stock. The valuation has no margin of safety, the chart looks bearish, there is potential for another drop, and the current price seems to assume a perfect future.
So is Robinhood a buy today? You know, there's just no single right answer here. It really boils down to your own personal investment philosophy. Are you the kind of person who believes in the long-term execution and is willing to pay a fair price for a great company? Or are you a value investor who absolutely needs that margin of safety before you're willing to pull the trigger?
In the end, that's the choice. Do you see a high-quality company trading at what looks like a fair price and decide to jump in? Or do you see a future bargain in the making and decide to wait for a better price? The right answer for you is all about balancing that patience with the courage to take action.